In week 4 of an escalating standoff, the Middle East looked ready to boil over. Following a fresh wave of Iranian missile launches with 2,500-mile capabilities, military action seemed inevitable. The immediate fallout hit global energy markets hard. The price of crude oil spiked, hitting a peak of $112 a barrel. Wall Street started buying insurance on a market that looked like it was already on fire. Investors braced for the worst, expecting this energy shock to trigger a massive surge in long-term inflation. The traditional math is straightforward. When a military conflict threatens a primary energy-producing region, the global economy prepares for a sustained downturn. This photograph captures the sea of green that hit trading terminals next. Instead of crashing, the stock market surged, jumping over 1,000 points in a single day. The panic buying evaporated. Traditional safe haven assets collapsed, with gold plummeting 25% from its recent record highs as retail speculation cooled off. Bond yields fell alongside gold. This specific metric tells us that institutional investors are suddenly pricing in luff inflation nervousness on the horizon. This sudden sense of market liberation is tethered to a physical reality, the status of one single bottleneck. This map shows the Strait of Hormuz. Global supply chains rely entirely on ships safely passing through this narrow waterway. When President Trump announced a 5-day hold on military strikes, the market viewed it as a calculated negotiation tactic to bring the conflict to a quick close. The threat of keeping the strait under U.S. control serves as a bargaining chip. It applies pressure to the remaining figures in the Iranian regime without committing to a prolonged physical war. All of the diplomatic deal-making and military posturing are focused on one objective: securing the uninterrupted physical flow of oil. At the crisis peak, global oil prices hit $112 per barrel. Anticipating an open choke point forced an immediate drop to $90. A fully secured strait brings the target cost down to $65 a barrel. Slashing the cost of the world's primary commodity by nearly half rewrites global supply forecasts and lowers the operational baseline costs for virtually every business on Earth. Wall Street's relief is mathematical. Dropping the base price of raw energy eases inflationary pressure across every sector of the economy. This image of a local gas station shows how those abstract global barrel prices hit the American consumer. Prices are sliding toward a critical psychological threshold, with the cost of a gallon of gas dropping back underneath the $4 mark. That drop provides immediate financial relief. It frees up cash in everyday households that was previously trapped by high commuting and transportation costs. Cheap gas is the requirement for revitalizing consumer confidence and spending habits in the broader domestic economy. When fuel costs drop, it effectively acts as a tax cut for every commuting household. That extra capital moves directly into retail and tech, the consumer discretionary sector, where spending is driven by choice rather than necessity. This sector has been heavily underweight and ignored by investors since the COVID pandemic woes, making it uniquely primed for a rebound. Institutional investors are already aggressively bargain hunting in this space, anticipating a sudden influx of consumer spending. This domino effect fuels a broader economic projection. An estimated 15. The global economy's trajectory relies on one physical requirement: the uninterrupted passage of ships through the Strait of Hormuz.